bringing in the question of some sort of public guarantee, some first loss piece or anything like that, is leading to yet another level of the debate, because it involves public money. But even without any public guarantees or anything, the platform could offer certain benefits out of the 7. So I think it's worth talking about it and continue this discussion, but probably not as part of the current package of proposals. That would be my 2 cents.
Wonderful. Yes, of course.
Thanks a lot. I have 2 remarks. So, Arne, at some point you have to explain to me that what we already did, and we can go on, how changing regulation leads to not only more synthetic and retained securitization, but really to true sale. I'm not sure I quite get that. I think we need to go beyond regulation. Anyways, that's a different discussion. Adam, I found your remarks very, very interesting. In terms of wholesale, of course, we have a wholesale digital currency. To some extent, it's called Target, right? But what you say is very interesting for the DLT pilot. I always wonder, if we look at the DLT pilot, and if we look at the plumbing in our system, wouldn't it make sense? I think it would, but the hard question is then how? To also eliminate the barriers we have to integration in our system when we use this new asset. What I mean is, you introduce a new technology. Isn't that a possibility to say, with the introduction of that new technology, I try to have a regulation for that technology that also, at least to some extent, gets rid of the tax and the security law and so on, divergencies we have? Because if we just shift everything to a new technology, but all of the other legal, corporate, and so on actions remain distinct across countries, then of course DLT will only get us so far in terms of market integration. So you get where I'm coming from. So how do we achieve that?
Yeah. So on so 2 questions. One is the pilot and the settlement leg, the digital currency. Those who are involved, we all know that there are really interesting experiments in the Eurozone as well as in the Bank of England to establish the link with the existing RTGS systems. And we know the Bundesbank, Banca d'Italia, and Banque de France pilots, and we know what the conclusion of the ECB on this. But and also the Bank of England is following an approach where they launched a new RTGS version, and they are using the API type of link of the blockchain to that RTGS system. So that I think that is happening, and there is a technological experiment. Of course, the ultimate would be issuing central bank digital currency on the chain natively, which is more or less the Bank of France model. So I think that there, my only comment on the EU pilot regime would be that it would need to be more successful. Some of the conditions would need to be relaxed or the scope expanded in there. But we are not far from getting to an outcome which could be scaled up, because here what we are talking about, the purpose of the pilot is to enable it to scale up there. There is a lot to do on the private sector side as well, because what is happening on the private sector is there are individual platforms. Some of them are on permission private chains. Some of them are on permission public chains, and these platforms are not talking to each other. So there is still a lot to happen on the private sector side as well. So I'm not only just putting all the burden or the blame on the public sector. The second question which you asked, I think making this transformation would not resolve everything. So a security would need to be issued under some sort of a law still. But what it could do is to overcome some of the fragmentation burdens of the infrastructure of the existing infrastructure, without the necessity of creating a 28th regime or something something really new in the regulatory framework. So I would say it would introduce efficiency even under the current legislation. The only point where I think change would be needed is the CSDR, and I mentioned why that would be necessary.
I don't know if there's time to respond to Daniel's point.
In 2 minutes, if possible.
The answer is that the miscalibration of various pieces of regulation, prudential and non-prudential, distorts price. So in order to have a market, you need a seller and a buyer who agree on the price. But the regulation increases price distortion. I'll give you a very good example of what I mean, an actual real example. I was talking last summer to a big issuer, there are no big issues anymore in securitization, but a biggish issuer in securitization who had discussed with some of his investors, bank investors, and they had said to him, listen, if the haircut on the liquidity coverage ratio for securitization, AAA, STS, super liquid securitization was the same as the haircut on covered bonds, I would be able to buy your paper for 8 basis points less. And I spoke to another person who was running a liquidity book for a very large bank in the Netherlands, and who said, yeah, we did the same calculation, and it was 12 basis points. So the additional haircut, which we would argue, we have the data to show, is not reflective of the risk. That additional haircut is a 12 basis point difference. The first bank said, when he was told 8 basis points, he said, at 8 basis points, that means I could start issuing AAAs at the same price point as my covered bonds. And that suddenly becomes much more attractive for me. So the answer to your question is, once you remove the price distortions that are not justified, obviously some price distortions are justified, but if you remove the unjustified price distortions, then you make it much, much more feasible for the seller and the buyer to agree a price. And if you look at other nations in the world where we don't have these price distortions, not just the United States, but Canada, Japan, Australia, just as an example, in Australia, I know I said 2 minutes. In Australia, 26 million people issued the same volume of securitization in 2024 as the whole of the EU in true sale form, right? So once you take away the price distortions, then we know from other countries that the market should grow. Can't promise it, but at least it's got the possibility to grow, and that's the answer.
And we're running 1 minute over time. If you allow me, Mahmoud, I'm just going to take the final question, and then I will give you the floor. But of course, briefly if possible, and then
I'll be brief.
Thank you so much.
The question was raised a couple of times where this risk appetite comes from in Sweden. I'll just say, if I can just comment briefly on that, I do not think our culture is characterized by high risk taking. If you ever had a Volvo or a Saab, you know what I mean. Our social safety net is among the most extensive in the world still. So it's typically not how I would describe our culture. But what we have had, more to the point, is a very long history, long before the ISK, of promoting exposure to this, because for your long run savings, exposure to securities and capital markets is rational for almost all people. And I think it's really about removing obstacles to that, and a lack of familiarity with these products is clearly such an obstacle. So that's really what's been going on in Sweden from at least the 1970s. Then it was mainly about tax incentives and mutual funds. 25 years ago, massive public marketing campaigns around the funded pillar in the public system, explaining why it's good for you, why you should consider using your choice when you choose mutual funds. And also in large privatizations where the state really advertises and says, you should consider buying shares in this company. Didn't always work out, and people kind of accepted that also. There is risk in this. But I think apart from what governments can do, and this has not mattered if it was a center-right or a center-left government. They have all been doing this for the last 30, 40 years. But in addition, employers and trade unions, the social partners, have bought into this for a very long time because they know it's in the interest of their members. I know this is echoing the Dutch experience, and that's where the big money is, and it really creates buy-in. Thank you.
Thank you so much for that. Just final thought maybe, and then we really have to go. You have a final thought. I know you have.
No,
No, you don't?
no. I leave my time to somebody else.
the end of the session. It was wonderful, wonderful conference as usual. Thank you to all of you. And now I leave you with Mahmoud, who will do the final session. Thank you very much.
So I would like to invite Mahmoud Pradhan. I already introduced you, Mahmoud, but for those who join later, Mahmoud is the head of global macroeconomics for Amundi Investment Institute and former deputy director of the European Department at the IMF. Are you mic'd up? Are you mic'd up? Mahmoud, I think they didn't go to be mic'd up. I don't know what the assistants are doing. Mahmoud, do you want to use these or to be mic'd up?
I'll use that. I think I'll use this. This is quick. Oh. I'll just give you 45 minutes.
Yes, yes.
For you. Thank you. Thank you.
Do you prefer this? Do you prefer this?
Yeah, I don't have mic. So in case my voice doesn't carry, I'll use this.
Okay,
Yeah?
okay.
Thank you.
In case you can keep it just 5 minutes shorter, even better.
Okay. Yeah. You know, Rolf, I might be forcing you to. Where's Harold? There. Oh, there's his mic up. That doesn't mean.
Yeah, 45 minutes. I thought that was the deal, whatever happens.
Yeah.
Hi, good to see you.
Nice to meet you. You have mics.
Yeah.
Yes. Hopefully they work. This one is.
Can we start, please? Can you hear me? Thank you. Okay, welcome to the final session. Given the time constraints, this is going to feel more like a quick fire question and answer. I apologize in advance. And I'm hoping that at the end, we were going to end with some optimistic notes. So that's an instruction.
Okay,
Okay.
I'll do my utmost.
Yeah, that's right. I think we've heard sufficient concerns, doubts, skepticism. So let me just briefly introduce the panel. So to my right, Christina Dias, am I pronouncing it correctly? Diaz? Diaz, yeah. Thank you. Oh, okay. Who's the head of cabinet of Commissioner Marie-Louise Albuquerque at the European Commission. Importantly, that's the arm of the commission that's in charge of financial services, and in particular this project. Christina has previously worked for the European Parliament and the Portugal's Ministry of Finance. And next to Christina is Harold, who you all know, but just very briefly, Director General for Economic Policy at the Austria Federal Ministry of Finance. But he also wears different hats in the EU, as you know, for the FSC and the ESRB Risk Board. Finally, Claude Marx, who is the Director General of CSSF. We had a colleague of yours earlier, so we know a little bit about your organization. You're also a member of the Board of Supervisors of ESMA. And with extensive experience in the private sector, you've been a former senior banker and a former CEO of a large insurance company. So with that brief introduction, I think the advantage of this panel is that for many of us, I put ourselves as observers of various things going on in Europe, in particular this particular project of capital market integration. But the advantage of this panel is these are seasoned, what I call seasoned participants. They're responsible for it, so to speak. Christina, the format is going to be quick. So I'm going to ask each panelist 2 questions. And then I will have a final round of 2 questions for all of them. And at the end, hopefully we have some time for a Q&A from the audience. So Christina, if I can start with you, and I want to focus on what are the barriers, the hurdles facing capital market integration. And obviously, given your role, we would like to hear what you think are the main barriers. My particular pet hobby, which you heard me talk about earlier, is the banking union a sufficiently big hurdle? I see that's what I think of as one distinction between the CMU and the SIU. The SIU now has banking union as an integral part. And I want to ask you, how does the Commission plan to reduce and or eliminate the major barriers? I mean, there are too many to go through a list, and the second question I want to ask you is about financial education. We've heard a little bit about aspects of financial education. What I want to know, how big are the gaps, your perception of the Commission's perception of the gaps in financial education? When I look at the US, just my own anecdotal observations where I've lived for a long time, I don't detect like a very big difference. Financial education is a complicated subject, but yet the US has a very different capital market. So is it incentives such as Europe has very different pension systems? We know Pillar 1 kind of may disincentivize people from looking for Pillar 2 and Pillar 3 and so on. What's the difference? And is this what's holding back investment? Let me stop there and ask you to address these 2, and then I'll move on. Thank you.
Well, thank you. Good afternoon. And these are not 2 questions. There are 6 or 7, if I count them correctly. So I'll try to go through them in a bit of order to present it a little bit. So barriers. We have a questionnaire out there to identify some of those barriers. But to be honest, most of them were already discussed today. So we know that for you to have a deep and efficient capital market, harmonized taxation would help. Harmonized procedures to collect taxes would also help. A common company law and a common securities law would also help. common supervision would also help. So there are a couple of barriers that we've been talking the whole day about them, and I think these are well identified. Some of them are still coming from Giovannini reports, and I remember talking about the Giovannini report when I was still very young in the securities regulator, and some of those barriers are still the same. I would say that the biggest barrier, which again has already been discussed a little bit today, is sometimes the lack of political will and the lack of commitment to remove some of them. And we've heard a lot about some of these hurdles belonging to or pertaining to the competences of the member states that need to take certain difficult decisions that are hard to take at certain points. Other times it's because there are some vested interests that come from particularly comfortable niche markets that we've all developed over time and are very comfortable to keep and to maintain. But all of that contributes to the barrier. So it's very difficult to tell you what is the biggest barrier that we have. I would say that at the same time, the biggest barrier and the leverage and the hope that we have is that the political momentum that we see growing to establish a true and effective single market for financial services is there. And we've heard it from several sources, several statements, several levels. So I would say that the fact that we have this political will, if materializes in actions, will help us to remove some of those complicated barriers. You also mentioned a little bit what are the instruments that the Commission would like to deploy to use them. And I'll go back to something that the Commissioner keeps saying. She keeps saying that she doesn't care about the instrument as long as it's effective. So be it legislation, be it coalitions of the willing, be it recommendations, you name it. We are not attached to a specific instrument, to a specific methodology, to a specific route. We just want to find things that work the more effective way and the quicker way to remove these barriers. And your last reference was to the banking union and whether this is the fact that the banking union is incomplete is part of these barriers. Of course it is. Because as someone was saying in a panel, I'm not sure whether my money in Portugal is as well protected as my money in Belgium. Or I don't know exactly if I am a company that I can remove my participation in a country in Portugal as quickly as I can remove it in the Netherlands. So all of that, the fact that we still don't have a seamless banking union is also part of the problem. We all know that there are steps that we need to take to get there. One of them is taking place as we speak. This morning there was another trilogue on the CMDI package. Let's see how negotiations progress. But we've heard from the member states that unless we make significant progresses on CMDI, we cannot talk about EDIs anymore. So we need to take this hurdle out of the way to make sure that we can complete the banking union as well. And we know that there are issues that will need to be addressed. Probably we need to come up with innovative solutions, with new ideas on how to remove them. But again, the Commissioner is rather agnostic on the methodology as long as it is effective. So this covers a little bit, I hope, your first set of questions. Going for financial literacy. Financial literacy is also something that we've discussed a little bit during the day. And I would say that I don't see necessarily a very large difference between the various member states or the US or whatever. I think that there was something interesting that was said, that people react to incentives. And probably if we apply the same type of incentives, people react more or less the same way. Of course, this is a very broad generalization, but exposed to similar difficulties, probably people react more or less the same way. So the fact that you are in the US or the fact that you are in Europe probably doesn't mean that much. What we know in Europe is that, and this has been demonstrated by Eurobarometer surveys, we still have a huge gap in terms of financial literacy. We still have lots of people that don't really know how to manage their finances. And I'm not talking about understanding the difference between a bond and a share, is managing their daily budget, their family budget. And this is where sometimes where we need to start. And we realize through these Eurobarometers that are disadvantaged groups and disadvantaged sets of the population that would probably require more attention. And this is something that we need to take care of. So irrespective of the fact of where you were born, probably there are commonalities between certain types of population that we would need to address in a more horizontal way. The other element is that there has been a lot of effort that has been put by the industry, by the supervisors, by the Commission, by the member states in defining strategies to increase financial literacy. The question is, are we putting our money where it is needed? And whether these campaigns are being effective. Because what we've seen, again, on the basis of this data from Eurobarometer, is that it's not being that effective. We don't see really a growing trend of people being more financial literate and being more able to understand the risks that they take. And another thing that was interesting that was also discussed today, and I think it feeds very well into this discussion, is investor protection. And again, one thing that the Commission has been saying is that we cannot protect investors from themselves. And sometimes looking at the customer journey, what it takes for a person to invest in a share, an ETF, and invest in crypto assets. Someone else was saying on a panel that these are very different things. But we think that people that invest in shares need to be protected. And people that don't invest in cryptos, we don't care. So probably we need to rethink what is the level of protection that really empowers people to make the right decisions for themselves and not protect them against taking risks that they want to take, but they are afraid of taking because of all the protections that we put on them. This is obviously something that needs to be coupled with financial literacy so that people can fully understand the risks. But we probably need to go in both directions and not only in the direction of continue to provide information. And this links to the customer journey. And this is a very broad word to say, how do we interact with people on financial markets? And the last element I would like to refer is sometimes we assume that we know what people want. And this is not always correct. I remember a long time ago that when the Commission was designing the PRIPS level, the PRIPS model for information, there were several interactions with stakeholders, but also with investors. And it was very, very difficult to find out what is the adequate level of information that investors want. So when we legislate or when we design campaigns, we assume we know what people want. Probably we should ask more people what they really want. And probably we should need to have it more targeted discussions. This is something that the commissioner is doing quite a lot because she's doing these visits to every member state. And when she goes on these visits, she talks to the usual suspects of the financial sector. So the industry, the supervisors, all the people that we are used to interact in this ecosystem. But she's also talking to researchers. She's going to universities and she's talking to the trade unions. especially because of everything that has to do with pensions, because we recognize that they are an important stakeholder in this context. And if we want to do something on pensions, we need to understand what their problems are and be able to explain to them why do we see this not as being a huge problem, or to demystify some of the issues that we've been listening about this project. So I would say that I hope that it covers your full set of questions.
Yeah, very well. Thank you. Thank you. I'm glad you brought the consumer protection risk thing, which I think is important. Let me turn now to Claude, and I'm going to try and keep the questions shorter. And the issue that I want to talk to you about, I know a little bit of your views, and we've heard about from your colleagues before. So how much harmonization, and it's about supervision, Luxembourg being a successful financial center, we've heard that earlier today. So there's a trade-off between, if we retain too many differences between member states in terms of supervision, then are we at risk of retaining a more complexity and not moving towards simplicity? There is a kind of need that if we can, we should try and make systems less complex and so on, which argues for something more uniform. But I know we've also heard that there are significant differences between member states in their tax structures, in their social security systems, etc. So can you speak a little bit to your kind of the way you see it? And it's not so much, many people accept the single rule book idea that we all operate on the single rule book, but maybe not accept the idea of a single entity as a regulator, right? So that's the first question, where you stand on this. And the second one is, I'm going to turn again to pensions, and Luxembourg has experience. We've heard about this before. To expand EU citizens' involvement in financial markets, in capital markets, is it primarily a question of Pillar 1 versus Pillar 2 and 3? People are comfortable with Pillar 1, so they don't have the right incentives. Do we need incentives, or is it something more deeper than that, which is something behavioral, that we need to change people's perceptions about what financial markets can offer to expand their involvement in financial markets, in investments?
Right, that's a whole program, but good afternoon.
But the requirement is quick fire.
Yeah.
Right?
So on your first question, I think that I would separate the issues of that you mentioned of taxation, social security, harmonization, and single supervision. I think that, of course, one of the weaknesses of the single market that we have today undoubtedly is the lack of harmonized taxation and the lack of harmonized social security. There's no doubt about that. The question then is, how feasible and in what time frame can we achieve this? And there was a former Dutch finance minister almost 50 years ago who had the idea to harmonize corporate taxation in the EU, and we are still nowhere. His name was Onno Ruding. And so I think if we want to achieve something in a reasonable period of time, we should be looking at things that can be achieved within a short period of time, which is where we need to be effective now. And taxation and social security won't work. As to the fact mentioned also in the Letta report, for instance, to the need for a single regulator or harmonized regulator, I think the question there is, again, it's about cost benefit, or what problem are we trying to resolve? When we had the great financial crisis in 2007, 2008, there was a realization that the current supervisory system could lead to financial instability to financial crisis. And so we had an important problem to resolve, and we came up with the banking union, and within the banking union, the SSM, the single supervisory mechanism. And that comes, of course, at a cost, because it is the SSM plus the national competent authorities. But I was always in favor of having that system and paying that price, because it would allow us to resolve an issue. And so today you have 113 large banking groups in the European Union that pose a systemic risk potentially, that are centrally supervised by the ECB. And it has worked. We have seen that it has worked through the COVID crisis, the supply chain crisis, the war in the Ukraine. And it also has worked with the one of the GSIP banks failing, Credit Suisse, 3 large US banks with balance sheet of 200 billion failing. All that has been withstood because of the system that we have today. So I'm definitely a fan of the system, and I think the system has worked. When you look to the broader financial markets, I think it's a different landscape. You have different languages, with 113 banks, they all speak English, they have the same governance, they have the same structure, so it's a uniform picture. If you look at savings products at large in the European Union, you have local customs, you have local languages, you have tens of thousands of products, if not more. You have tens of thousands of suppliers of products, manufacturers, and so on. It's a very different picture. So thinking about a single supervisor in that space, I think is feasible, but it is from a cost-benefit perspective, I'm not convinced that this would be necessary. And then there are variations. You could take parts of that landscape and try to have a single regulator for parts of it. I don't think that this is a primary weakness that leads to the weakness of the Savings and Investment Union or Capital Markets Union. I think there are aspects that are more important. The chairman of Société Générale was saying earlier in a panel that, the market wants a single regulator. Well, I can also tell you from where I sit, heading a regulator of 1,000 people, that the market wants the regulator to be accessible. The market wants proximity to the regulator. And of course, all these things are a little bit difficult if you have one for all. What is important is that we become more efficient in some subparts of regulation and supervision. And my prime example here would be, and that's again talking also to the market, the prime problem that people face is the different reporting systems in different countries. If you operate today in 6 countries in the European Union, you will have to report in 6 different ways to regulators. You will be asked different questions, different reports, and so on. And so I think here we have something that we need to change. We need to have one set of questions that are being asked throughout the European Union by the NCAs, but no more. So I think that is very important, and that's also what the market is telling us. Then, there are, of course, other things. They have all been mentioned already in the panels today. I won't repeat them, but I would concur with what Christina said. That it doesn't matter how we do it as long as we achieve the purpose. But that also implies that we don't try to build something overly complicated. Also, we have instruments today in the European Union that we don't use to the full extent. One of the reasons why people want convergence is that people don't trust each other in the European Union. Therefore, we try to regulate everything to the little detail, which creates complex rule books. So we need to overcome that and have more trust. How can we have more trust? that is to avoid regulatory arbitrage, and that can be achieved through the ESAs. You know, the ESAs are safekeepers today of regulatory arbitrage. And if people don't stick to it, then you know, there is breach of union law and other procedures that are available and that could be used more often to bring people to respect the law. I remember that when we had money laundering issues in various places, some reactions said, well, we have money laundering issues. That means that the 6 or 5 at the time AML directives are not effective, and we need a 6th and a 7th and an 8th and so on. But if you look at what happened actually there, people were not following the first directive that was 30 plus years old. They were not looking who is the customer and what are the transactions for, which means that the countries that have failed on this should have been sued for breach of union law as opposed to adding new layers of regulation. And I think there are many examples like this. So my take here is that you know, we don't necessarily need a single regulator, but we need to identify inefficiencies and make good use of the ESAs as safekeepers of convergence and single rule books that we have today. And they do good work. I can testify that. So your second question, I will be briefer on that one. I think the second, third pillar are to me one of the key elements to have a better capital markets union. If you look today at the European Union, many countries have or will have in the near future or the medium-term future a pension issue. And then, of course, the question is, how do you resolve that pension issue? You can strengthen the first pillar. Of course, that is one possibility, not necessarily efficient. You can also do it like some member states have successfully done in the European Union, like some of the Nordic countries, but also Holland, you know, have a quasi-mandatory or mandatory second and third pillar, or second pillar, sorry, occupational pensions, and then a tax incentivized third pillar. And if you then make sure that the majority of money is invested within the European Union, that is certainly a big boost to the savings and investment union. The other big problem, or the other big point where we should work on is, and that is to do also with financial education. You know, today 41% of savings in the EU are invested in cash, or invested, I mean, are sitting in cash, where people lose purchasing power compared to inflation. People don't understand this necessarily today. If we move 10% of that money into the markets, that would be a huge boost. And so I think a combination of those will be very effective.
Thank you. Harold, let me turn to you. And the first question, Harold, is, and you've been involved in these discussions for a very long time, why has progress been very slow? And if you can help us identify where's the kind of roadblock, or where's the resistance coming from? Is it member states, gold plating, etc.? Is it supervision? Is it national market structures? And the second question is, and this is my thing I was talking about earlier, the banking union kind of was embraced in principle wholeheartedly, especially by, well, all member states, but especially by the industry, which is rare in these types of things. How important are banks going to be in shifting what we just heard from Claude, this large volume of deposits more into capital markets? And can it be done if we don't complete the banking union? I mean, Claude has given us the kind of magnitudes involved, and we would get quite a long way there if we could move some of this. But do banks need to be involved? Because what we observe is very limited cross-border flows in the banking industry.
Right. On the first one, why has there been so little progress? I think part of the answer is we don't really know what to measure progress against. I mean, we've had 2 capital markets action plans with loads of legal dossiers that were finished, and just counting the numbers, there's actually been a lot of progress. But you tell me, what is the end game of capital markets union? When are we going to say it's actually complete? I mean, sometimes it helps to ask the simple questions. And so that is part of the problem. And the second problem is that we actually come from very different starting points, and people have very different concepts of what capital markets union, or SIU as it's now called, is supposed to be. To some people, capital markets union means strong national capital markets that cooperate. To other people, it means, of course, a deep capital market pool somewhere. But we've never resolved that. To some people, capital markets union is more consumer protection. To other people, it's exactly the opposite. To some people, it means joint supervision. To other people, it means, no, we don't need joint supervision. And so on and so forth. We have this headline, capital markets union. That's where we want to go. But at the political level, we have not resolved the inconsistencies between what it actually takes to get there, namely, reform insolvency law, if you want that, and the headline. So we're only, I mean, we've had, I don't know how many summits where everybody subscribed to capital markets union, and everybody is in favor. But once we start, for instance, the issue of harmonized accounting standards, then people start realizing, I have to change my national system if we want to go there. No, let's not have that. Let's start from my national accounting system, and now people have to be ambitious to implement my set of rules. That's the usual debate. And yeah.
I was careful not to say, when will we complete it? So I was careful to say, why have we not seen more progress?
Yeah.
So let me define
progress to what goal?
Yeah.
So,
okay.
and,
One
but I
yardstick.
can tell you what my definition is, and that's another issue that I wanted to bring in here. I think, I mean, the only logical endpoint is if everybody, every entity, every private individual that needs refinancing or investment for a certain purpose gets an offer at a reasonable price.
Okay.
But this is tied to another question. Does this mean the refinancing has to come from European sources or not? I personally think no. I don't think a capital markets union can be successful if it's not completely interlinked into the global financial system. So I find the debate about strategic autonomy, I struggle with the idea, because to me it makes no difference if we say, okay, we need those 800 billion to go into sustainable energy production and digitalization. Well, for the sustainable energy production facilities and the digital facilities to be there, it doesn't matter whether the money comes from the US or from Europe. The facilities will be the same. The energy will be just as green. The digitalization will be just as digital. So, and here, that's also a dimension that I miss in our debate.
I will come back because I don't want to take up too much time. But I guess implicit in what you're saying is that one side of the capital market, the SIU, is to mobilize Europe's large savings into investable secure instruments, securities, maybe, right?
They could be put to better use, of course. We all agree on that.
One kind of dimension we're looking at, okay? But you're saying, well, even that doesn't matter as long as the investment comes from somewhere. When people want to borrow, entities want to borrow, they get it. Whether it comes from the US or global investors.
Depends on what the purpose is.
Sure.
What's the purpose of capital markets union?
But implicit in that, and I'm raising this as a question. If people start out by saying, for example, the letter Draghi reports that Europe has lots of savings, but not enough investment. We need more investment for our other goals, better growth, competitiveness, so on, right? Is the SIU might deliver some of that higher investment, which you're saying that's also a question mark, but we'll leave it for that. Let me.
No, on that, I actually, you asked me to be optimistic, but you said something on an earlier panel that I also happen to agree with very much. I mean, why do people invest? They invest because there are profitable projects. So it's we can do whatever we like with financial education and, I don't know, facilitating the flexibility of deposits. But if we don't have a profitable project, you know, with a discounted cash flow that leads to a result that I can accept in the end, why would I invest, even under the best of rules and regulation? And I'm not sure. And this is again, this is tied to another issue that people forget. Capital Markets Union, the financial sector, is intrinsically linked to the real economy. And if our real economy is rubbish because we because we don't provide the right environment for entrepreneurs, because, I don't know, approval processes take 10 years, then of course we don't have projects that are as profitable as some other undertakings across the Atlantic might be.
Okay. I want to give some time for questions, so I'm going to ask.
But the banking, you want? Should I ask on the banking sector, or should I just leave it? No,
brief.
I think, of course, the banking sector is part of the answer, but only, I think, when it comes to securitization, because it's actually there where money moves out of the balance sheet from the bank and to a part of capital markets. I think the bigger role is actually for insurers and IORPs. That's my short answer. Yeah.
It's about progress and ending on the optimistic note that I started out with. But if we were to reconvene in 2 years and ask the same question, and Claude, I'm going to start with you at the far end. How much progress should we expect, and what will be in your view progress? The reason I'm asking this is there seems to be some added impetus for this project now, under a different label and a genuinely different construct as well. It's not just labeling.
So I'm moderately optimistic, first because you gave me an order to be optimistic, but second also because I am an optimist. I think, look, Europe is typically quite asleep when things are going well, and Europe is typically better when it's in crisis mode. And I think we are in crisis mode now, because if we do nothing, we become insignificant. And also we have an issue with the defense, and we have an issue with digitalization, innovation, and so on. So I think we are against the wall, and I think we will react. And I think the SIU is one piece of the equation. I think the Commission's simplification and burden reduction agenda is key. And I truly believe that we will have achieved quite something in 2 years' time. I'm optimistic on that. There are other parts of the equation, and here I join Harold also on what he says. You know, there are other frameworks that we need to improve. And I'm thinking in particular on antitrust regulation in the European Union that has been very restrictive. So we complain that we have no big champions, but if we had big champions, then it might be a problem. And the other part, I think, where we have been very protective for good reasons, but maybe a little bit over the top, is GDPR and anything to do with data protection.
which has an impact, a negative impact on innovation and development, research and development, and so on. So I think we need, I think it's a whole, but if we talk again in 2 years' time, I think we will be better.
I think there's a guaranteed success if Donald Trump stays in the White House and continues with his tariff agenda. Because, I mean, if you remember what's in the Draghi and Letter reports, the idea that we export our capital to the US and then it comes back, that's just the reverse of net exports. And if he manages to reduce our trade surplus, capital will just stay in Europe. And at least by that benchmark, we will have been successful. Actually, we are already successful because we know that most asset managers are now underweight on the US, and that's why we see an appreciation of the euro. So Trump is actually a great help to
So
the
in
project.
3 years' time, we may need only a very short conference.
Yes.
Just
And
declare some kind of
we
victory.
can thank Donald Trump.
That's okay. Thank you. Christina, please.
I would say two things. I think one of the successes that I expect to see from this is more retail investors investing more in capital markets with confidence in good projects. I fully agree with you. We also need a pipeline of good projects and good instruments where it makes sense to put our money. And the second thing I would like very much to see is the continued political commitment to deliver effectively and not simply to promise on what we will be delivering. So two very short things I hope we'll be celebrating in 2 years' time.
Okay, thank you. Let me open the floor to any questions. No? Rolf.
This is a question to Claude Marx, and given the hour of the day, maybe also a slightly provocative one. But I mean, Luxembourg was praised for being a great financial place for financial business, and I agree with that. And I think that there are very many reasons for that. But among others, was also said, why changing a successful supervisory model if we have a case like Luxembourg, where this is obviously part of the overall picture. If one could tomorrow add an E to your name in terms of making ECSSF, you would be the European supervisor. In your view, would European capital markets be a better place? And if so, why?
Look, I don't think so. You know, we are a big finance center. We have today 118 banks in Luxembourg and 3,000 odd investment funds and a few other players. But it is to do effective supervision, and I think we are audited more than the market is audited all the time. So I think I can say that it works, but it takes 1,000 people to do it, just on the proximity of what we supervise. And I don't think that the CSSF would be able to properly supervise any savings products and the whole of financial markets in the European Union. And I don't necessarily think it would be a good thing. I think what we need is the ESAs, and I will add to that AMLA, which is the latest authority that is coming into life now, transitioning from the Commission to its own governance. To make sure that the standards that we have, and those standards should be regulation, not directives. I think directive should be something that is that. We should only work with regulation, and anything new coming out now is regulation. And then we need somebody keeping an eye on the supervisors that they apply correctly the rules. we need also FISMA to guide sometimes on level 1 when there are interpretation questions. And we need colleges, we need also what we now did twice at EU level, which is Supervisory Convergence Network, where we peer review the establishment of new firms to make sure that things are applied in a uniform way across the EU. We did it for the Brexit firms. We're doing it now for crypto asset service providers. And then I think we will be good. So I don't think CSSF looking at it all would be a good thing.
Any other question? Yes, Daniel.
A really short one, because you mentioned crypto service providers, right? Isn't there an obvious case, at least for these new things, that we don't do? I mean, it's a global market, it's a global thing, that we don't do this nationally. Shouldn't at least these kind of things be under EU supervision for? So it's a serious question. I have no idea, but to me, this would make intuitive sense that we don't look at this nationally from the beginning on.
I guess you're talking to the regulator. I think what is the most important thing is that there is no regulatory arbitrage, and that agreements and licenses are granted and supervision is done in a consistent way throughout the European Union. It could be done by a single regulator. That would be, again, a huge task if I just look at the number of applications coming in everywhere. Or we can do it by making sure that we apply the regulation in a consistent way throughout the EU. The system we have self-elected to do in that particular case, because there is no level 1 or level 2 basis for this, but we have elected as 27 member states to review jointly key crypto asset service providers. So nobody is able to issue a license before there has been a peer review of the file. I find this quite a good system, actually, which is it's lean, it's up and running in a short period of time. It works, and that is, again, to me, and to come back to Christina, that's again an example where I think we came up with a system even outside of a level 1 or level 2 or whatever framework, that where we say, okay, we need to avoid arbitrage here, and this is the way to do it. And so it could be done centrally, but it doesn't have to be done centrally.
Yes, Harold, please.
Maybe on that one, because I haven't spoken on this before. I think there are areas where a European supervisor makes more sense than in others. And I would personally think on crypto assets, probably the balance tilts towards the European supervisor, not just because of harmonized supervision. Because I remember very well a visit from a Treasury Secretary in Vienna who happened to be the Secretary General of the FATF before we had AMLA, and the Americans were vehemently opposed to AMLA. And he was very frank about it. He told me, well, we want to be able to bully individual countries. We don't want to deal with a big body like Europe. It's easier for us to bully Lithuania or Austria. That's why we don't like AMLA. And that's precisely the reason why in the area of crypto asset service providers, this might be a very good idea. On other areas, of course, I mean, we discussed it in the past whether the financial plumbing, the infrastructure, CCPs would also not be a good case for European supervision.
It's done.
But yeah, we have. It's true. We have the directive in place, but they're also, to be honest, I know Klaus Löber is doing a very good job, but they're underfunded. They're not able to do a good job right now.
If I may.
Yes, please. Yeah.
If I may add a further argument, I think in a new area, everybody will need to develop the resources to assess it. So probably if this is something that you have not yet started doing, probably pull it together and do it only once or do it at a single point. It might be easier for everybody. It's a further argument that can be added to the discussion on whether this should be, at what level this should be centralized. But this is at least an argument that merits to be discussed and considered in the context of the discussion.
Thank you. Any more questions? I don't see any. Wow, this is we're on time. Okay, let me just finish by saying thank you very much to all three panelists. Thank you. And let's give a round of applause, please.
Go.
I don't know if I can understand you. That's fine. You can, what do you prefer? Okay, well, first of all, thank you very much, everybody. This were almost 2 days of very rich, very good discussions. I won't take much time to try and summarize because I won't be successful. But I think we started out with the kind of the observation, as somebody I think yesterday said, Europeans are very good savers and they're horrible investors. So there is not a lack of savings. I would argue there's probably not a lack of investment opportunity, although maybe improving further or completing the other single market in goods and services might even help more with investment. It's the middle in between. It's intermediation that is missing, where it's heavily bank-based and where other players don't quite have their role or are too national. They're not having the sufficient scale on the European level. Second, it's about people. It's about people and firms. And so it's important to also think about why is it that households don't invest outside banks? It is maybe also about investor protection or more generally consumer protection. It is also about firms. We haven't talked as much about firms here, but I think that's also an important point, especially smaller firms who are currently completely limited to banks. We talked about products, venture capital. Yesterday, we talked about bond markets, equity markets. We talked about securitization and the role of it. And we talked about different players, the banks, the non-banks, policies. Talked a lot about supervision and how much it should be concentrated or centralized. We talked about a 28 regime, convergence processes, taxes, incentives more generally. So overall, there seemed to be a lot of moving pieces. And I think that was an observation of very early on when we still called it CMU. It's not like the banking union where we had, well, originally we had 3 pillars. Now Nicola has reduced it for us to 2 pillars. So it's a shopping list, as somebody said, which one can say maybe it has a negative connotation, but maybe that's what this is, because the non-bank segment is just much messier than the banking system. It's because it's so diverse. However, I think it's also important to think, we know policymakers, the general public, or even stakeholders have a limited attention span, if I may say so. So we need to kind of focus on where do we start first? Where do we get the biggest bang? Where are the low-hanging fruits? But at the same time, also create momentum and create maybe champions in the kind of policy sense in terms of driving the process forward. Now, I asked yesterday, is third time the charm? Because this is the third attempt at the Capital Market Union or Savings and Investment Union. Well, I guess I would answer today, well, the third time has to be the charm because of the situation which we are living in. So we are almost condemned to success, I would say. There was just now a brief discussion on what would actually constitute success. And I would kind of disagree here and say, no, it's not the number of legislation. It's not the number of directives. It is really that we can then see in the financial system, for example, as Christina said, the share of retail investors that actually, for example, invest in European products or go just a little bit more riskier. I think that will be the success. But ultimately also, and this was also mentioned, finance is not a purpose in itself. The financial system as such, from the societal viewpoint, is not a purpose in itself. It is about economic growth. It is about transition to net zero. It is about innovation. And it's always nice if after 26 years you can quote your own PhD thesis. It's not necessarily about so the finance and growth literature has actually shown that the link between financial development and growth does not necessarily come through quantity, through investment or savings. It's more through productivity growth and the reallocation, more effective resource allocation. And I think that's really what we should focus on when we talk about the Saving Investment Union. Now, two more final remarks. First, a big thank you, especially to our hosts, Nicoletta, Rolf, and others from the ESM, and especially also, which is often forgotten, to the administrative team, Maria and all of her colleagues, the logistics administration, and so on. And very finally, on the program, it says closing remarks. And yes, these are my closing remarks. In a moment, Nicoletta comes. But I don't think we should see this as a closing of the discussion. It's just actually an opening, I would say, and hope we can continue that. Thank you very much.
I will take just 2 minutes. I know that you are all a bit tired after these 2 very intensive days. So I just want to offer a few thoughts as we wrap up this conference. And I want first to highlight the importance of the debate we have had in these 2 days. The discussions were very rich and thought-provoking. And from many of you, I heard that you enjoy actually the availability of many thought leaders to exchange their views and also to exchange contrarian views, because we need to have this type of exchange in order to move things forward. And also we need to acknowledge the complexity and the multidimensional nature of this important strategy that we want to implement. So this initiative, the Saving and Investment Union, holds great promises, but it also poses a lot of challenges. So this is why it's essential to approach this in a multidisciplinary way and with an open mindset. And this is what we have tried to do with this conference. And I have 2 final messages. One to the research community. Yesterday, we went through many interesting papers. And unfortunately, many of the researchers had to catch their flights and are not here. But the message I want to convey is that we need to continue to advance this research. There is still a lot to understand and to develop. Please continue to push this agenda forward, because in order to develop our policy effort, we need strong evidence. And maybe with better evidence, we will also be able to respond to the question, but where do we want to go? What is the end game? And how can we measure progress that we have actually achieved in 2 years' time? Second message, and something that stood out to me from a paper we analyzed yesterday on regulatory cooperation, and that we discussed yesterday, but the message was greatly reinforced by the policy discussion we had today. Harmonization is not enough without cooperation. And over these 2 days, we have had also very good example of cooperation across institutions and across borders that work well. And I think that with effective cooperation, we can really turn this policy ambition into practical progress. So I think the Saving and Investment Union will become reality if we continue to make effort to develop strong cooperation and we continue to foster coordination. I hope this is a message that you will take with you and you will help in your own role to turn into practice. I hope the conversation sparked here continue well beyond this conference, and I thank you all for your participation.